Good evening, ladies and gentlemen. This is Barry Norman on behalf of ETX, and welcome to our class MACD, Moving Average Convergence and Divergence. Now, this is one of the new classes we're adding in for this semester. So tonight is going to be the first time I'm presenting it, but I've been trading with MACD for almost 20 years. But I'm going to try to put it in a clear, concise manner that we can all pretty much understand. But before we get started, ETX is a regulated provider, so I'm therefore required to give you a risk warning. Trading in the financial markets can result in the loss of the amount invested. Do not trade with funds that you cannot afford to lose, and seek advice if you do not understand the risks. All information that's provided in this webinar is for educational purposes only. ETX Capital and the presenter are not financial or investment advisors, and we do not recommend any securities or instruments of any kind. Any securities or instruments that are mentioned throughout are for educational purposes only. Now, for those of you that are joining us through an internet promotion, ETX is, like I said, a regulated provider. We are a fast-growing financial services company based in London. We are authorized and regulated by the FCA, the Financial Conduct Authority. We're also a member firm of the London Stock Exchange. When you trade with ETX, you can trade on our binary options platform, which is a great way for beginning traders to start out, or another way to try out your strategies in a low-risk environment. But if you want to trade CFDs, spread betting, Forex, you can trade on our ETX Pro web-based platform, or you can use our advanced ETX MT4 downloadable platform. Any which way you want to trade, we make available to you. Just contact customer support and they'll get you set up on whatever platforms you want to trade on. Now, tonight, again, we're going to be talking about moving average, convergence, and divergence. I actually like saying that. So let's get started. Now, this indicator was developed in the late 70s, and it's got this rather ground-sounding name, Moving Average Convergence Divergence Indicator. And it's actually one of the most commonly used momentum indicators around. I don't know how it gained so much popularity. When I started using it, like I said, about 20 years ago, it was, when you have pre-online trading and post-online trading, the world changed around, but I think the name caught on a lot to people. The fact that it's easy to read when you see it on your screens, and the fact that it works pretty well, helped it gain in its popularity. It is used to spot changes in strength, direction, momentum, and the duration of a trend. MACD is one of the most popular and broadly used indicators in Forex trading. So the letters MACD is the abbreviation for Moving Average, Convergence, and Divergence. We're going to say that a lot tonight, so get used to it. The basic function of the MACD Forex indicator is to discover new trends and to help identify the end of a current trend. There are various ways to gauge the signals generated by MACD, and many traders use their own unique settings and methods around this trading indicator. Now, the trading device is a popular way to use MACD, and the MACD histogram, which is another part of MACD, and we're going to be talking about that a little bit later. Okay. But let's first get a general understanding of MACD. MACD is an indicator that is placed on the bottom or underneath of your charts and moves with price, and you can see the relationship between price and the movement of the indicators. And when certain things happen with these movements, they give you specific indications. So, okay, I'm sorry, let me back up here a bit. So the MACD is typically placed on the bottom of the trading chart in a separate window beneath the price chart. The moving average, convergence, divergence is a relatively easy to use tool. And that's the nicest thing about it. It's very easy. Now tonight, we're going to be talking about the 5 lines and the steps to actually put these on your charts, because you should understand what each of these lines or where they come from. But because it's such a popular indicator, you don't need to do any mathematical calculations. Excuse me one minute, I have somebody who's not hearing me and he thinks it's my fault, and he's just writing a note after note. So let me just get back to him. Oh. Okay. Now, I'm sorry, let's get back to this. So, the concept behind the MACD is fairly straightforward. Essentially, it calculates the difference between an instrument's 26-day and 12-day exponential moving average, an EMA. An EMA is just a variation of a simple moving average that gives more weight to the most recent prices. Of the two moving averages that make up MACD, the 12-day EMA is the faster one, while the 26-day is slower. But that's only if you're using daily charts. If you're using a 1-hour chart, remember when we talk about a moving average, and we're talking about a daily moving average or a 1-day moving average, it's on the assumption you're using a 1-day time frame. If you're using a 1-hour chart, that 26-day moving average would be 26 time frames, or 26 hours. In the calculation of the values, both moving averages use the closing price of whatever period is being measured. On the MACD chart, a 9-day EMA of the MACD itself is plotted as well, and it acts as a trigger to buy and sell signals. So I'm going to take you back to my opening screen here. Okay. So it's hard to see in my background, and you don't actually see this when you put them on a chart. But what you do is you have a 26-day moving average and a 12-day moving average, just a simple moving average. Now these are numeric values. The moving average on your price chart doesn't tell you anything. That, you can use it for other things, but it's not part of the indicator. It's part of the calculation. Okay. Because what we do is then we come down here and to get the MACD line, we use a 12-period EMA, which is this 12-period, which is just a number from there. Because to plot this, you have to calculate the number. So we're using the 12-period exponentially moving average minus the 26-period moving average. So if you're looking at hypothetically gold is trading at the moving average for a 12-day is 1250, and the moving average on the 26-day is 1247, what you have is the 12-period minus the 26-period, or a 3. And then that is the line that is then plotted and it's called the MACD line. Then the next step is we would take this MACD line, or this MACD number for each period, and we would then calculate that in a 9-day moving average. And then that would be plotted, and that is called your signal line. So it sounds a little bit complicated, but it really isn't. You take first a 26-day moving average line. Okay? So how would you do that? If gold was trading, you're looking at a 1-hour chart, and gold is trading at 1250 now, 1254, 1254. You'd go back 26 periods, add them together, divide it by 26, and that would give you the average. Correct? So that gives you, in that case, 1250. Okay. Then you go back and use a shorter period moving average, or a shorter period moving, which gives you, you're using a 12 period. So if gold had popped up a little bit in that period and fell down, and then ended up back at 1250, and you add those 12 periods together, and you would get, say, 1251. So you then just simply take the 1251 minus the 1250, and that gives you a number 1. And you have a 0 line on the chart below your charts. This is your 0 line. Okay, and then these lines are plotted using 1s, 2s, 3s, whatever the number is on this 0 line. So this is 0, minus 1, minus 2, minus 3, plus 1, plus 2, plus 3, and you just simply drop those numbers on the chart for your MACD line. You then take that MACD line, which in this case, say, was the 2, the 1250 minus the 1252, and then you take the next periods and say that was 1, and and the next period, say that was 2, and the next period it was 3, add them together for 9 periods, and then divide them and put that number on your chart also. And that gives you your MACD signal line. Now, we'll go through this a couple times tonight because when we get over this, because the next thing we're going to look at is what's called the histogram. Okay. But that's a separate part of this step. So, and I'll give you these precise calculations, but the fact is you don't need to do any of the calculations. But the trading divergence is a popular way used for the MACD histogram, but unfortunately the divergence trade is not as accurate. It fails more than it succeeds. So you have convergence and divergence. Convergence is when the lines come together. Divergence is when they cross over. So it depends on whether your signal line is crossing your MACD line or your MACD line is crossing your signal line. And it's just what it says. One diverges and one converges. So we'll try to go through it again step by step. The name is based on the lesser moving averages of price continually converging and diverging from the greater moving average. The default setting for these two are 12 and 26. Now, all of the MACD studies you read will be based on 12 and 26, but there are lots of strategists out there and lots of people out there trying to teach on there that have developed their own system using a 2 and 20, a 14 and 22, a 50 and a 90 to do their calculations. You can also develop your own, but then you have to test them because then they're no longer using the developed or the standardized MACD calculations. So as you can see here, the first thing we're going to do is we're going to take and calculate our moving averages. Okay, and those can be dropped on a chart if you wish. But it gets confusing when it's on your chart, so we drop them below by using our calculations. Now, MACD is perhaps the best all-around study available. In a downtrending market, the fast-moving average will move down faster than the slow-moving average. So in other words, if you have a very fast-moving market, your shorter period moving average will move more quickly than your 26. Because imagine when you're using 26 periods and the market just started moving in the last 8 periods, the 12-period moving average is going to move a lot faster than the 26. It's just the opposite in a downtrending market. Okay. So what it does, it makes these lines work in opposite directions. So in downtrending markets, the fast-moving average will move down faster than the slow-moving average. As the fast-moving average diverges from the slow-moving average, MACD will illustrate the relationship. In uptrending markets, the 12-period EMA should move faster than the 26-period EMA. Now, you have to understand what's causing these lines to move. Then what happens is these lines will either diverge or converge. They will come together. Now, notice that the MACD helped traders notice that the trend change in a very early stage. When we see the divergence and the convergence of these moving average periods, we can interpret those from these lines. So what we see here is the MACD line, the red line, moves below the 0, and the MACD line moves above the 0. And remember, we had the 0 line on the chart. And remember, this line is simply the difference between these two EMAs above on the chart. So if the EMAs were equal, what would they be? they would be zero at the zero line. If one EMA was bigger than the other EMA, and since you're using the difference between the 12 and the 26 EMA, it would either be a negative or a positive number. So when they cross the zero line is exactly the same as when they cross over on the charts. So we no longer put these on the charts. What we do is simply use the zero line, and when we see a cross below or a cross above the zero, means we either had a divergence or a convergence. Pretty simple there. Okay. So MACD will cross the zero line as the fast-moving average intersects the slow-moving average. Okay. So we don't need to be looking at the lines above, and that's why it doesn't plot these on your chart. It just plots them below. So remember, so now that was only the red line. Remember, that's the MACD line. Then we have the signal line, which in this case is the blue line. The signal line, okay, is the 9-day moving average of the difference of the 12 and the 26. Now, it also moves above and below. And it also then here crosses here, which aren't the same crosses as here, because the crosses here, the divergence over and under here, where the moving averages cross, is only the red line. So the MACD uses a combination of these crossovers and the signal line, which is the average. So what this does is give you the double indicator, the double line. So it makes it different than just a moving average crossover. Because there's lots of formulas, there's lots of strategies out there using a 50 and a 90-day moving average. That has nothing to do with MACD. Those are just standard moving average strategies. What this does, it takes it one step farther. So let's go over to a real chart and see if we can show it to you in real time and explain it a little bit easier for you. So let me pop up some real charts for you here. Let me get my markings off the... And as you can see here, this is a current chart for the Euro-US dollar. We just simply go to the indicator, and we're looking at a 30-minute chart, and we simply go to the indicator here and came down to the MACD indicator and clicked on it. Now, I'm going to force these on a chart for you. So what we have here is the MACD line and the signal line. Okay. Now we can go into format and we can color code these so you understand what they're. So we're going to make the MACD line a bright red. And we're going to make that very, very bold. And then we're going to take the signal line. Remember, the signal line is only the moving average, the 9-day moving average of the MACD line above it. And we're going to make that a little bolder. And then we have, let's make the histogram in blue so it's easier for you to see also. So what we have is the red is our, what? Our MACD line. The green is our MACD signal line. And then we have the histogram. And we haven't gotten to the histogram yet, but if you start to learn to use this, you can, maybe as a crutch, you can put the moving averages on the chart above. But then they just confuse you. You need to learn the differences between you have to learn to read them on the chart below. So if you keep looking at when you put them on your chart, your actual price chart, you're simply looking at a standard set of moving averages. So if you remember right, what we have, and I'll keep reinforcing this, the red line is your MACD line. Your MACD line is simply the difference between the 12-day moving average and the 26-day moving average. Your green line is then the average of that red line. When they cross above or below zero, at the zero line, which is where you see the histogram going above and below, at that zero line, and actually let's see if I can make that zero line darker for you. Nope, I can't. At the zero line, the moving averages are equal. Okay. If they fall below, they're converging. If they go above, they're diverging, because it's only simply the difference between the two. When the moving average, the 12 and 26-day moving are equal, they're zero. Okay. So then all we have is, again, the green, which is your signal line. And your signal line is actually the important line. When the signal line and the MACD line cross, that's the significant point. Okay, that's when you get the signal line gives you your buy and your sell signals. Okay. So just being above or below the zero by itself doesn't tell you anything, because again, it's simply the two moving averages above. So if you had a 20-day and a 50-day moving average, you subtracted them, you would just get your standard moving average crosses. So it's when the moving averages, the difference of the moving averages, reacts with the 9-day average of that 9-day moving average of that line, hence the green. So what we're going to be looking for or keying into are these areas. When we have the crossover, which is either a divergence or a convergence, because if you notice in some places the green line is underneath and comes above the red line, in some places the green line is above and goes below, and that's the difference between a convergence and a divergence. Now first you have to master this before you can master the signals. But when these happen, it's giving you specific buy or sell signals. So these relationships don't have anything to do with the zero line. But they are calculated based on the plots of the zero line. But then we have the histogram. And the histogram is actually the difference between here and here. And that's put on a histogram. So actually, so when you see this histogram at zero, as the zero line, what we do is we just had a meeting of the two lines. So more experienced traders who use this pay no attention to most of it, because they're just looking very quickly at the histogram. All the histogram is a pictorial representation of what the two lines below, the signal line and the MACD line, are doing, and the red MACD line is simply a visual presentation of the difference between the 12 and the 26-day moving average. Hopefully I got that across. I mean, it's a lot to comprehend, but now we have them on the charts, and we have to start to learn how to interpret them. So let's go back to my PowerPoint. Uh-oh. There we go. So the MACD signal line, or the signal line, can be helpful for noticing potential trend changes at very early stages. However, if we wait for the zero line crossover, MACD to cross the zero line, we are essentially trading a moving average crossover, which is inherently lagging the market and may not be the optimal entry point. This is where the signal line comes into play. The signal line is simply a moving average built on the value of the MACD line. By default, the value is commonly set at 9 periods. So we had 12 and 26, now we have 9. Okay, this is the signal line that we've been talking about. It's built on the relationship of the MACD line itself. Traders will often look for entry points or entry opportunities when the MACD crosses the signal line. When the MACD line crosses above or over the signal line, it is looked at as a buy signal. And when the MACD crosses below the signal line, it is looked at as a sell signal. So the MACD is the red line. Just let me get my marker back on here. And we had the same on our chart before, our real time chart. So the MACD is the red line. And when we see the red line cross below the blue line, the signal line, that gives us a sell signal. When we see the opposite way, the red line cross above, it gives us a buy signal. Now, this is not in relationship to the zero line. It is simply when one crosses the other. And if you look very carefully at the price charts, you'll see that right after, because the MACD combination, or using the crossover of the two MACD lines, is what makes it different than just using standard moving averages. Because if you use standard moving averages, they tend to actually lag right behind the market. So moving averages strategies, they're called lagging indicators because they're always slightly behind. Now, by using the MACD calculations and using the 9-day moving average line or the signal line, when it crosses the MACD line, it is a leading indicator and therefore generates signals to enter the market. So again, what you're looking for is what? You're looking for the red line, the MACD line, to either cross over or under the blue line, which is the signal line. And when that occurs, if the red line crosses down and below the signal line, it's a sell signal. When the MACD crosses up and over the signal line, it's a buy signal. Now, to confuse things a little bit more, if the two lines were to touch each other, what would they be equal? They would be equal to 0, correct? Because when the two things are on top of each other, they're the same number. When one crosses over the other and one rises higher, one line will be larger and one will be smaller. If the red line crosses over the blue line, it should give you a larger number. And it's just a difference between those two lines. If the red line crosses below the blue line and you're subtracting the red line from the blue line, it would give you a negative number. And it would give you only small little numbers. And if you plotted these on your zero line and used a histogram, which is just a line chart, to note what number they were, because if the moving average from the MACD line was at 1250 and the MACD signal line was at 1250.25, the difference would be 0.75. And if you were to put that 0.75, the difference of that, on your histogram chart, you wouldn't have to look for the crossovers, because every time it would touch the zero, it would be at the point of crossing. It would be touching each other. And if the next histogram bar was below, what happened? It came down here to this area. If the next histogram was above, it came above, and therefore it was a sell signal. So let's see. Let's go back to the real live charts. So what you see here is this histogram, which is the blue lines, simply the bars going up and down, the lines going up and down. All they are is the difference, the mathematical difference between this line and this line. When you take the red line and you always subtract the green line from it, what are you going to have? Okay. If the red line is below the green line, you're going to have negative numbers. If the red line is above the green line, it's always going to be positive numbers. And if you just take that difference and plot them on your chart, what does that tell you? Well, when you're at zero, they're crossing over. If the number's rising higher, tells you the MACD line is rising above the signal line. If it's falling below, the MACD line is below the signal line. Because eventually, what you'll start to see is you'll actually start seeing patterns of movement in your histogram, and you'll just know that at each one of these zero lines you have the crossover. And this helps you see visually easier the strength and the development of that crossover. So all it is steps, moving from a standard moving average down to a more defined calculation and a more precise indicator. So the histogram is an effort to more closely follow the relationship between the MACD and the signal line. Traders can follow the histogram, which is simply a bar chart plotted around the zero line to indicate the relationship between the MACD and the signal line. Notice in the graphics to the right, when the MACD crosses the signal line, the histogram will appropriately cross the zero line. So you can see here we got the green histogram, and again we have the same still red and blue MACD lines and signal lines. So when MACD crosses the signal line, the histogram will cross the zero line. The histogram will illustrate the relationship between the MACD and the signal line. So when MACD crosses up and over the signal line, the histogram will climb above zero. And when MACD crosses below the signal line, the histogram will dip below zero. So eventually, you simply look at the histogram. So you can also see here the relationship from the histogram. Okay, again, it was at zero at the cross, and it rose as the MACD line got higher than the signal line. So more experienced traders simply look at the histogram. Okay. So the MACD proves most effectively in wide swinging trading markets. There are three popular ways to use the moving average convergence divergence, and that's using crossovers, overbought and oversold conditions, and the divergences. So the basic MACD trading rule is to sell when the MACD line falls below its signal line. So when the MACD dips below the signal line, it is a sell signal. Similarly, a buy signal occurs when the moving average convergence divergence rises above its signal line. So as you can see on this chart to the right, here we have what? We have a sell signal because the MACD fell below its signal line. And we can see how it predicted what was happening in the market. Because if you're just using a moving average, you wouldn't have gotten the crossover till here. Here it gave you ahead of that. Now again we have our other crossover here. We see our histogram is at 0. It's giving us a buy signal. We would have entered the market here slightly ahead of where the moving averages cross, but well within that change of the markets. Again here, 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 and here. Here and here. Okay. And it helps move us in front of if you were just using simple moving averages. And if you're using the crossovers here, it gave you very good entry points into the market and very good sell and buy signals. So again, we can see it here exactly in. Here it showed us the downtrend, and when we got the sell signal, it started a downtrend. Here we got a buy signal, and it was already in a movement towards an uptrend, but it wasn't a confirmed uptrend. At this point, you would have entered the market with a buy, okay, slightly in front of the blue line. So you'd have gotten in the market somewhere about here. Again, here we got the sell signal. You got that sell signal just about here. You would have been able to take advantage of that all along here. Again, here. So you can see how reliable, when you get these true signals, they are very, very reliable. Now also, MACD will tell you when you have overbought and oversold conditions. The MACD is useful as an overbought and oversold indicator. When the shorter moving average pulls away dramatically from the longer moving average, in other words, the MACD rises, it is likely that the price is overextending and will soon return to more realistic values. So it's telling you the market is overbought. Then we also have the divergence. That's an indicator that an end of the current trend may be near occurs when the MACD diverges from its symbol. A bullish divergence occurs when the moving average convergence indicator is making new highs while price is falling to reach new lows. So in other words, if you see price falling and making lower lows than a downtrend, but you see the MACD line moving in an uptrend, what do you have? You have a divergence. They are moving in the opposite directions. Okay. That's telling you that the MACD is making higher lows while the price is making lower lows. So that is telling you that the current trend is about to end. And look at that. They both predicted here that trend will be about to end, and it gave you a perfect buy signal here at the breakout. Now you do have to learn these. You're not going to learn them tonight. You're not going to practice them tonight. You're not going to be trading with them tomorrow, because these are skills you have to adapt. They're visual clues you have to see. They're not very complicated. But here we have a beautiful bearish divergence. A bearish divergence forms when a security records higher highs and the MACD line forms lower highs. Okay. So there is an out of relationship between the price movement and the MACD lines. And you see that here. So you see higher highs, which is more like an uptrend and a trend line, while the MACD is making lower highs. It's moving in almost the opposite direction. Now, I'm going to try to wrap this up, but we're going to go over this pretty quickly. I know we've talked about this till you talk to death about it, but the MACD histogram is an indicator of an indicator. It's simply crunched all the numbers from the different ways we've done it and put it on this one little histogram. In fact, the MACD is also an indicator of an indicator. This means that the MACD histogram is 4 steps removed from the price of the underlying security. In other words, it's a 4th derivative of price. Because the first derivative is the 12-day moving average minus the 26. The second is the MACD line, which is the 12-day moving average less the 26-day moving average. The third derivative is the MACD signal line, which is the 9-day EMA of the MACD line. And then the fourth derivative is the MACD histogram, which is the MACD less the MACD signal. The base for the indicator is the security's price. It takes 4 steps to get from the actual price to the MACD histogram. Talk about massaging data. Okay. While not necessarily a bad thing, chartists should keep in mind that when analyzing the MACD histogram, it is an indicator of an indicator. Therefore, it is designed to anticipate signals in MACD, which in turn is designed to identify changes in price momentum of the underlying asset. And you'll find this is one of your most reliable signals and the easiest to use. It's not very complicated because it's all put on those charts for you. It's just being able to read that and knowing which is when they cross or they diverge, what it's trying to tell you. So as with the MACD histogram is also designed to identify convergence, divergence, and crossovers. Because the MACD is simply the difference between the MACD line and the signal line. The MACD histogram, however, is measuring the distance between the MACD and its signal line. The histogram is positive when MACD is above its signal line. Positive values increase as the MACD diverges farther from the signal line. Positive values decrease as the MACD grows closer to signal lines. It has become standard to plot a separate moving average alongside a MACD, which is used to create a clear signal of shifting momentum. You should never use any signal by itself. You should have a secondary indicator that will verify that there isn't something else going on in the markets. So as mentioned earlier, the MACD indicator is calculated by taking the difference between the short-term moving average and the longer-term moving average. Given this construction, the value of the MACD indicator must be equal to 0 each time the two moving averages cross each other. In the previous example, the various signals generated by the indicator are easily interpreted and can be quickly incorporated into any short-term trading strategy. At the most basic level, the MACD indicator is a very useful tool that can help traders ensure that short-term direction is working in their favor. Now, the biggest disadvantage of using this indicator to generate transaction signals is that a trader can get whipsawed in and out of a position several times before being able to capture a strong change in momentum. As you can see in the chart, the lagging aspect of the indicator can generate several transaction signals during a prolonged move. So it means the harder the move, you will get buy and sell signals, and because these buy and sell signals don't predict how long to stay in the market, if you were to buy and then sell, then enter and exit, you wouldn't be able to capture in one trade all the momentum of the market. But traders should be aware that the whipsaw effect can be severe in both trending and range-bound markets because relatively small movements can cause the indicator to change directly quickly. The large number of false signals can result in a trader taking many losses, small losses. When commissions are factored in the equation, this strategy can become very expensive. Well, when you're trading CFDs and that's it, you need to be able to use another factor and determine how far you expect that if it's giving you a buy signal, where you expect your target to be, because the MACD doesn't tell you price target. It tells you entry points, but it doesn't tell you how long it will go or where to, where you should target or where you should be exiting the market. So you need to have other indicators to factor in that equation. But the MACD works extremely well, and its sell signals and buy signals are fairly reliable. Very few indicators in technical analysis have proved to be more reliable than MACD. And this relatively simple indicator can quickly be incorporated into any short-term trading strategy. So, on that note, guys, I'm going to say goodnight to everybody. I'm kind of talked out here. I hope you learned something. It sounds confusing, and I've tried every which way when I built this class to try to figure out how to do this easy. I tried to do it with calculations. I tried to do it with boards. And it just isn't. It's a whole bunch of little mathematical calculations that are very simple. And then understanding them and seeing them. But you'd be surprised, with a little bit of practice, you'll have it down pat. So thank you very much for joining us. Hope you had an enjoyable class, and we'll talk to you again on Sunday, I believe. Thank you very much. Good night now.